Hi everyone! In this video, we will be um, learning the other contemporary strategic cost management techniques. So far, we have actually discussed other strategic cost management techniques such as our total quality management, and then we also discussed benchmarking. We also discussed balance scorecard and the value chain. So, we will learn some other contemporary strategic cost management techniques in this presentation. So, what are these techniques? We have JIT or just in time, we have life cycle costing, target costing, and theory of constraints. So, let's describe each of these um, one by one. So, JIT or just in time is the philosophy that activities are undertaken only as needed or demanded. So JIT is a production system that is also known as pull it through approach, in which materials are purchased and units are produced only as needed to meet actual customer demand. In a JIT system, inventories are reduced to the minimum, and even in some cases, the inventories are zero. Then we also have life cycle costing. Life cycle costing is a management technique to identify and monitor the costs of a product throughout its life cycle. It consists of all steps from the product design and purchase of raw materials up to the delivery of and service of the finished product. Target costing. Target costing involves the determination of the desired cost for a product or the basis of a given competitive price so that the product will earn a desired profit. So, the basic relationship that is observed in this approach is target cost is the difference between the market determined price minus your desired profit. Okay, so that is your target cost. Then the last technique is your TOC or theory of constraints. The theory of constraints is a sequential process of identifying and removing what? Constraints. No, from the word itself, theory of constraints. So we will remove constraints in a system. The theory of constraints emphasizes the importance of managing the organization's constraints or what we call barriers that hinder or impede progress toward an objective. So let's learn each of these techniques thoroughly. So again, first we have JIT, just in time production system. It's a pull it through approach. JIT here, activities are again undertaken only as needed or demanded. So, just in time production is also known as the lean production system. Lean production. Why do you think it's lean? Imagine a lean person. So later on, we will understand why this is called also lean production. Again, this is a demand pull manufacturing system because each component in a production line is produced as soon as and only when needed by the next step in the production line. In a JIT production line, manufacturing activity at any particular workstation is prompted by the need for that workstation's output at the following workstation. So, in other words, it is the demand that triggers each step of the production process. Starting with the customer demand here, when the customer places an order. So, starting with the customer demand for a finished product at the end of the process and working all the way back to the demand for the direct materials at the beginning of the process. In this way, demand pulls an order through the production line. This demand pull feature of JIT production systems achieves close coordination among workstations. It smooths the flow of goods despite low quantities of inventory. So, what are the key features of a GIT production system? First key feature is maintaining a limited number of suppliers. So, a company must learn to rely on a few suppliers only who are willing to make frequent deliveries in small lots or small batches. Dependability is very essential here because companies are highly vulnerable to any interruption in supply when JIT production system is in use. If a single part is unavailable, the entire assembly operation may have to be shut down. Second key feature is the improvement of the plant layout. Manufacturing flow lines in the company's plant must be improved. In a JIT production system, all machines needed to make a particular product are often brought together in one location. So, this is what we call focused factory approach, so that partially completed units are not shifted from place to place all over the factory. And this is to minimize handling and moving. So, by doing this, the company can dramatically reduce throughput time, or um, what we also refer to as cycle time, which is the time required to make a product. Another key feature is the reducing of setup time. What do we mean by setups? Setups are those activities such as moving materials, changing machine settings, setting up of equipment, and running tests that must be performed whenever production is switched over from making one type of item to another. So this is applicable if your company is producing more than one product. If unproductive setup time can be made negligible and batch sizes can be made very small, then the company can respond quickly to the market, reduce cycle times, and make it much easier to spot manufacturing problems before they result in a large number of defective units. Another key feature is improving our production scheduling. So JIT businesses schedule production in small batches just in time to satisfy needs. So we don't overproduce, okay? There should be good coordination of efforts throughout the value chain. So, from the time the orders are received from the customers to the time the goods are manufactured and ready for delivery to those customers. And then another key feature of JIT is targeting zero defects. Defective units create very big problems in a JIT environment because they could delay the shipment of the order and may generate a ripple effect that delays also other orders. Although it may be next to impossible to obtain a zero defect goal, companies have found that they can come very close through continuous monitoring. This procedure makes the company's production workers directly responsible for spotting defective units, which should be rare, okay, and the supervisors and other workers determining immediately the cause of the defect and correcting it before any further defective units are produced. Early detection of the defective units saves rework and scrap costs. And then the last key feature of JIT is the maintaining of flexible workforce. Companies that use JIT production system must have workers who are flexible and multi-skilled. Workers assigned to a particular JIT product flow line are often expected to know how to operate all the equipment on that specific product line. Cross training also increases flexibility, boosts employee morale, and decreases costs. So, are there any financial benefits of JIT? Yes. So, here are the following financial benefits of JIT. First, it lowers investment in inventories because, again, we will only purchase raw materials only when needed. So, when can we say that it is needed? When there is a particular demand for specific number of finished goods. Okay. So, we don't overstock our inventories. So, as a result of having lower investment in inventories, there will also be reductions in the carrying and handling costs of inventories. So instead of renting a huge space for storage of the inventories, we will only rent a small space so we can save on storage costs, handling costs of the inventories. There's also a reduction of risk in obsolescence of inventories since we don't overstock our inventories. There will be no excess supply of inventories and these excess supply of inventories may actually lead to obsolescence or damage to those inventories. So if we are to use JIT, we have less inventories and then we have also less risk in obsolescence of inventories. And then we also have lower investment in plant space for inventories and production, reduction in setup costs, and eventually total manufacturing costs. Setup costs are actually part of our factory overhead. So, if our setup costs will be reduced, the effect will be a decrease in our total manufacturing cost. If you remember the formula to compute total manufacturing cost, we have direct materials, direct labor, and factory overhead. Then there will also be reduction in the costs of wastes and spoilage. And as a result, this will improve quality. Then we can generate higher revenues as a result of responding faster to customers. There's also reduction in paperwork. Okay, so we have here an illustrative problem on the implementation of JIT production system. Okay, here, XYZ Corporation, a manufacturer of copper fittings, is considering implementing a JIT production system. The following data are gathered: 100,000 pesos for annual tooling costs to reduce setup times must be incurred. So if XYZ Corporation will implement a JIT production system, it has to incur this cost, 100,000 annual tooling cost in order to reduce the setup times. And then average inventory will be reduced by 500,000. Relevant costs of insurance. The insurance here pertains to the insurance for the inventories. So insurance, storage, materials handling, and setup will decline by 30,000 per year. The required rate of return on inventory investments is 10% per year. Quality will be improved and rework will be reduced on 500 units per year, resulting in savings of 50 pesos per unit. There will also be better quality and faster delivery, which will enable the company to charge 2 pesos more per unit. So there we can charge an increase of 2 pesos per unit on the selling price on the 20,000 units that it sells each year. So the question is, should the company implement the JIT production system? Okay, I'll give you time to think and analyze. So, how should we decide on this? How can we help the company decide whether it should implement the GIT production system or not? So, hint, compare the benefits versus the costs of implementing the GIT production system. Benefits versus cost. Okay. You may pause the video if you want to, if you want more time. So let's start with the analysis on the benefits. As part of the benefits of the company, we should also consider the savings, right? Savings, cost savings are part of the benefits that the company will experience should it implement a JIT production system. Okay, so first, savings or benefit is the uh, reduction on the carrying costs. Carrying costs, third one, relevant costs of insurance, storage, materials handling, and setup will decline by 30,000 per year. And then plus the required return on inventory, right? Because the average inventory will be reduced by 500,000 per year. And then granting that the return on investments is 10,000 per year. So that's the cost we need to recoup. So that's 10% of 500,000. So that's 50,000. Then add it to the rest of your carrying cost savings, which is 30,000. So you have 80,000. What else? You also have rework savings, right? The second to the last item here. Quality will be improved and rework will be reduced on 500 units per year, resulting in savings of 50 pesos per unit. So since there are 500, the reduction of 500 units per year, and then the savings per unit is 50. So that's 500,000 times 50. That will give you 25,000. What else? What are other benefits? Notice that we can also increase our price. We can charge 2 pesos more per unit on the 20,000 units that we can sell each year. So that is 20,000 units, rather 20,000 units times 2 pesos. So the increase will be 40,000, right? So add all the benefits, you will get 145,000. And let's compare this to the costs of implementing the GIT. So the cost of implementing GIT is this 100,000, right? Annual cost. Tooling cost to reduce setup times. So that's 100,000. So again, total benefits if we are to implement a GIT production system is 145,000. While the cost of implementing the GIT production system is only 100,000. So since the total annual benefits and cost savings exceed the annual GIT implementation costs by 45,000, the company should implement a GIT production system. Furthermore, better quality of the product and faster delivery would surely result to more customer satisfaction, which will provide long-term benefits to the company. I hope you understood it. Now let's look at some performance measures and control in GIT production system. So the following describes the measures that the managers use to evaluate and control the GIT production and how these measures are expected to be effective. So for the financial performance measures, example of financial performance measures is your inventory turnover ratio. So for the financial performance measures, these are expected to increase. For non-financial performance measures, these are measures of time, quality, inventory, such as, for example, manufacturing lead time, units units produced per hour, number of days of inventory on hand. We have the ratio of the setup time with the total manufacturing time. the ratio of the number of units requiring rework over the total number of units started and completed. So most of these non-financial performance measures are expected to decrease, except for the number of units produced per hour, which is expected to increase. Personal observation and non-financial performance measures provide the most timely, intuitive, and easy to understand measures of plant performance. When we say timely, that means meaningful feedback is critical because the lack of inventories in a demand pull system makes it urgent to detect and solve problems quickly. So, what is the effect of GIT on our costing system? The GIT systems reduce overhead costs through the reduction of materials handling, warehousing, and inspection costs. So, it really reduces our factory overhead. It also facilitates direct tracing of some costs that are usually classified as indirect. So, if we are to implement a GIT production system, some indirect costs might be reclassified as direct because the implementation of such system will help us directly trace some of the cost to the product. Okay, so that is for JIT. The next technique that we have is the life cycle costing. And here we have to identify and monitor the cost of a product throughout its life cycle. So this um this topic, life cycle costing, focuses on the time dimension of cost management. So consideration is given to both the effects of the timeliness of operations on the total costs of the product and the way in which these costs change over the life cycle of the product. So, product life cycle is considered in aspects. Two aspects of life cycle, okay? Product life cycle. First aspect is the cost life cycle. Cost life cycle. And then the second aspect is the sales life cycle. So, what is this cost life cycle? Cost life cycle is the sequence of activities within the firm that begins with research and development, followed by design, then manufacturing, then marketing or distribution, and customer service. Sales life cycle, on the other hand, is the sequence of phases in the product or services life in the market. So this starts from the introduction of the product or service and then to growth in sales, and finally, maturity, decline, and withdrawal from the market. Okay, so let's look at first life cycle costing on the aspect of cost life cycle. Okay, so this is what I've mentioned a while ago, the difference between the cost life cycle and the sales life cycle. So this one is our cost life cycle. So the total cost over the product's life cycle is often broken down into three components. We have the first component is upstream activities. Second component is the manufacturing or the production itself. And then the third component is the downstream activities or the downstream costs related to the downstream activities. So again, for cost life cycle, we will start with the research and development, followed by the design. So these two activities are referred to as upstream activities. And then after your design, you proceed to the production of the products, and then proceed to the distribution and then customer service. These last two activities are referred to as your downstream activities. So this is the cost life cycle. Now, the subcomponents of these costs are as follows. So, for upstream activities, again, we have the research and development. This is when um, we will try to figure out what type of or what kind of product are we going to offer. And then this is more of the planning stage. The design is when we proceed to the production of a prototype, testing, concurrent engineering, and quality development. Now, there are industries with very high upstream costs. They invest more on research and development and design. And examples of these companies are computer software companies, specialized industrial and medical equipment companies. Then for production or manufacturing, the costs related to this one is, say, purchasing of your materials, direct manufacturing costs, which include your labor, and then indirect manufacturing costs, or what we commonly refer to as factory overhead. And then for downstream costs, we have marketing and distribution. So under these, we have the packaging of our products, shipment, giving out samples, promotion, advertising. And then last activity will be the customer service activity. This is more of the service and warranty. Like if we have product recalls, service, product liability, customer support. Now, there are also some industries with low upstream activities but with high downstream activity costs. Examples are those that include uh, products related to pharmacy, drugs, legal drugs, then cosmetics. So, among these activities, the decision making at the design stage is the most critical part. Although the costs incurred at the design stage may be small in relation to the total costs over the entire life cycle, the stage decisions are important because they lock in most of the remaining life cycle costs. So the critical success factors at the design stage include reduced time to market, reduced expected service costs, improved ease of manufacture, and process planning and design. So what do we mean by reduced time to market? The speed of product development and the speed of delivery and efforts to reduce time to market are critical for a business firm to sustain its competitiveness. Reduced expected service costs by careful, simple design and the use of interchangeable or modular components can reduce expected service costs. When we say service costs, these are those that relate to customer service, the last stage or the last activity. Then, improved ease of manufacture. The design must be easy to manufacture in order to reduce production costs and speed up our production. And then, lastly, is your process planning and design. The plan for the manufacturing process should be flexible, allowing for fast setups and product changeovers using computer integrated manufacturing computer as the design and concurrent engineering. So here are the common design models. Is again the stage is very critical. So let's look at the four most common design methods. We have basic engineering, prototyping, templating, and concurrent engineering. Let's describe these models very briefly. Basic engineering. This is a method in which product designers work independently from marketing and manufacturing to develop a design from specific plans and specifications. So the design speed of this model is fast, while the design cost depends on the desired complexity and functionality of the product. Another model is prototyping. This is a method in which functional models of the product are developed and tested by engineers and trial customers. So the design speed for this model is slow, while the design cost is significant because it requires really materials, labor, and time because we are to produce a prototype. Another design model is templating. This is a design method in which an existing product is scaled up or scaled down to fit the specifications of the desired new product. The design speed of this model is fast, while the design cost is just modest. Then the last model is concurrent engineering. This is also called as simultaneous engineering. This is an important new approach in which product design is integrated with manufacturing and marketing throughout the product's life cycle. So there is continuous improvement of the design. Design speed here is continuous, while the design cost is significant because design is considered as an integral ongoing process under this model. So let's look at an illustrative case on life cycle costing and pricing. Okay, the company here has introduced a new phone, a very small phone that it can be carried in a wallet. That's small. The company invested, take note of these infos, okay? The company invested 400,000 in research and development for the technology, okay, 400,000 in R&D, and another 800,000 to design and test the prototypes. The company predicts a 4-year life cycle for this model and gathered this cost data for the wallet phone. Okay, we have manufacturing costs with a monthly fixed cost of 25,000 and 20 pesos for the variable cost. We have marketing costs as well. Fixed is 20,000 and variable is 5. Customer costs monthly fixed is 3,000 while the variable is 8. Distribution cost fixed amount is 5,000 while the variable cost is 15. And then we have several sales prediction. If we are to price it at 150, this is a very, I don't know, very cheap product. Anyway, this is for academic purposes or to simplify our example, okay? So for a price of 150, there will be an average annual sales of 80,000 units. If we are to price the product at 180 pesos, our predicted sales for the year will be for each year will be 60,000 units. While if we price it to, oh sorry, this is not 150. This is 225. Please take note for price of 225, the average sales is only 48,000 units. Now, if the price of the product is 225, the company will have to increase the research and development costs by 100,000 and the prototyping costs to increase by 400,000 to improve the model to justify the higher price. The fixed customer service cost would also increase by 500 pesos per month, and the variable distribution costs would increase by 5 pesos per unit to improve the customer service and the distribution at the 225 pesos level. At the lowest price of 150, as shown here, fixed marketing costs would be reduced by 5,000 per month because the low price will be the principal selling feature. Okay, so first requirement is to determine the life cycle costs for each pricing decision. Again, we have here three prices 150, 180, and 225. 25. So, in your paper, make three columns. The first column will be for the price of 150. Second column will be for the price of 180. And then um, third column will be for the price of 225. Okay. I'll give you time to analyze and answer. Okay. Let's proceed. So again, three prices: 150, 180, 225. So let's compute our revenues for that particular sales price. So again, if we are to sell it at 150, we can sell 80,000 units. So that's 150 times uh 80,000 80,000 units. So it will give us revenues of 12 million, right? For the price of 180, 60,000 units. So just multiply the two and you will get revenue of 10,800,000. For the last price, 225, we can sell 48,000 units. So 225 times 48,000, you will get 10,800,000. Let's look at the costs. First is the research and development costs. I've mentioned this. This is not in the table. So I've mentioned this before. If the if the selling price is 150, the research and development will remain at 400,000. Same goes with 180 sales price. The research and development is 400,000. However, as I have supplemented, no, it says here that if the price is 225, the research and development cost will increase by 100,000. Therefore, at the price of 225, research and development will be 500,000 instead of 400,000. Then for the prototypes, for the production of the prototypes, the cost is 800,000 and that is for both prices 150 and 180. However, if for the price of 225, the prototyping cost will increase by 400,000. So just add 400,000 to the usual or the ordinary prototype cost, which is 800,000. So you will get a prototype cost of 1,200,000 for the sale for the sales price of 225 pesos, right? Okay. Now let's look at the manufacturing cost. You have fixed and variable, right? So for the fixed, the same, fixed. 1,200,000. How did we arrive at 1,200,000? Okay, that's 25,000 per month as shown here in the table. 25,000 times 12 months per year times 4 years because I've mentioned that the company predicts a 4-year life cycle for this model. So that's times 4 years, you will get fixed manufacturing of 1,200,000. How about for the variable? Okay, for the variable cost, that is 20 per unit. for a while. Let me get my calculator. Okay, so that's 20 per unit. Just multiply it to the number of units for each selling price. Okay, and then you will get your variable costs for each selling price. Then for the marketing, we have fixed and variable. The same procedure with what we've done for the manufacturing costs. And then customer service. Same procedure, except that. Okay, let's go back to marketing first. So for marketing fixed, I've mentioned a while ago that at the lowest price level of 150 pesos, fixed marketing cost would be reduced by 5,000 per month because the low price would be the principal selling feature. Take note of that in your calculations. And then for the customer service, additional information with regard to the selling price of 225, I made mention that fixed customer service costs would increase by 500 per month, and the variable distribution costs would increase by 5 pesos per unit to improve the customer service and distribution at the 225 peso selling price level. Okay, so that is for customer service and distribution. You can pause the video if you want to. Make sure that your total cost at the selling price of 150 is 7,344,000. 7,344,000. Total cost at selling price of 180 is 4,176,000. Total costs at 225 selling price is only 3,988,000. Okay. Now, another question. What price will produce the most profit for the company? What price will produce the most profit for the company? Is it the selling price of 150? Is it the selling price of 180? Is it the selling price of 225? So all you need to do is to deduct the total costs with the expected revenues for that particular selling price, and whichever gives us the highest net profit will be the best price. So based on our calculations, it is the selling price of 150. This is the price that renders the highest expected profit. Let's verify. This gives us a profit of 4,656,000. Okay, wait. Let me just verify. Right. So the revenues for 150, that's 12 million. Total cost is 7,344,000. Yes, it's 4,656,000. And then for price of 180, that is 10,800,000 minus 4,176,000. That is 6,624,000. Mm. Then for the price of 225, that's 6,812. Okay, sorry. I will change my answer. The price that will produce the most profit is 225 pesos selling price. Okay, 225 pesos. Okay, so that's it for the cost life cycle. Let's proceed to the sales life cycle. So the sales life cycle again is the sequence of phases in the products or the services life in the market. Okay, we have the introduction of the product, then growth, maturity, and then decline. So the audience or the buyers for a product at this stage are those that are referred to as early adopters. Then for the growth, mainstream, maturity are the late adopters, and then when the product is in the decline stage, the audience are the laggards. Here the market is small for introduction and the sales are low because our products are relatively new. Competition is also low, and then our focus is to create awareness. We have to increase our advertisement and promotion. Our design focus is on the tuning of the product. For the growth stage, the market here is growing, so we can expect that our sales are high. The competition here is moderate. Our business focus instead of awareness, because at this point, the target market are already aware of the presence of our product. So our focus is to obtain a huge market share. The design focuses on the scaling of the product. At the maturity stage, the market is already large while the sales are flattening. The competition at this point is high, while our business focus is customer retention. Design focus is on the support. And then on the decline stage, the market is contracting, the sales are moderate, and the competition is also moderate. Our business focus is on the transition as well as on same with design focus. So again, first stage or first phase of the sales life cycle is the product introduction. So in the first phase, there is very little competition and sales rise slowly as customers become aware of the new product or service. Costs are relatively high because of high research and development expenditures and capital costs for setting up production facilities and marketing efforts. Process are relatively high because of product differentiation and the high costs at this phase, while the product variety at this phase is very limited. On the growth phase, here sales begin to grow rapidly and product variety increases. The product continues to enjoy the benefits of product differentiation. There is increasing competition and prices begin to soften. Third phase is maturity again. Sales continue to increase but at a decreasing rate. There is a reduction in the number of competitors and of product variety. Prices soften further and differentiation is no longer important. Competition is based on cost, given competitive quality and functionality. And then the last phase is your decline phase. Here, sales will begin to decline, as do the number of competitors. In here, the prices already stabilized. Emphasis on differentiation returns. Survivors are able to differentiate their product, control costs, and deliver quality and excellent service. Control of costs and an effective distribution network are key to continued survival. So let's look at the entire sales life cycle as to the management focus. So in the first phase, the focus of management again is on the design, differentiation, and marketing. Then the focus shifts to new product development and pricing strategy as competition develops in the second phase, which is your growth phase. In the third and fourth phases, management's attention turns to cost control, quality, and service as the market continues to become more competitive. Thus, the firm's strategy for the product or service changes over the sales life cycle. So, from differentiation in the early phases, then to cost leadership in the final phases. So, as to the strategic pricing strategy, The strategic pricing approach changes also over the life cycle of the product or service. So, in the first phase, which is introduction, pricing is set relatively high to recover development costs and to take advantage of product differentiation and the new demand for the product. In the second phase, pricing is likely to stay relatively high as the firm attempts to build profitability in the growing market. Alternatively, to maintain or increase market share at this time, relatively low prices might be used. In the later phases, we have maturity and decline phase, pricing becomes more competitive and target costing and life cycle costing methods are used as the firm becomes more of a price taker rather than a price setter and makes efforts to reduce upstream and downstream costs. Then, lastly, as to the cost management system. Together with a change in strategy and pricing, there is also a change in the cost management system. At the introduction phase and into the growth phases, the primary need is for the value chain analysis to guide the design of products in a cost efficient manner. Master budgets also are used in these early phases to manage cash flows. There are large developmental costs at the time when sales revenue are still relatively small. As the strategy shifts to cost leadership in the latter phases, which are your maturity phase and decline phase, the goal of the cost management system is to provide the detailed budgets and activity based costing tools for accurate cost information. Okay, let's have this illustrative case for sales lifecycle analysis. The management accountant of the company has collected these data in preparation for a sales lifecycle analysis on one of its products. So we have here, if you can look at the table, annual sales for this year is 2 million. If we compare it to last year's sales, that is 1.5 increase, while the average annual change over the last 4 years is 19.6%. Unit sales price is 400, which is 2% higher than last year's. However, the average annual change over the last 4 years for our unit sales price is actually 6.9%. Then the unit profit is 180 pesos this year, which is a decline of 0.8% from last year's. However, if you look at the average annual change over the last 4 years, that is actually an increase of 2.5%. So our goal here is to determine what stage of the sales life cycle the product is in. Is it in the introduction stage of the sales life cycle? Is it in the growth stage? Is it in the maturity stage or the decline stage? You may pause the video. Okay, so it seems that sales are already stabilizing since they only grew 1.5% over the past year, and the average annual growth over the past 4 years was 19.6%. The unit sales price has also slowed down, and the unit profit is beginning to decline. As a result, total profit is starting to level off. Now, because of these signs, it seems that the product is in the early maturity stage. Okay, so I hope you agree with me that the product is already in its maturity stage. Okay, now let's proceed to target costing. Target costing is a technique in which the firm determines the desired cost for the product or service given a competitive market price so the firm can earn a desired profit. Okay, so um, target costing is actually done at the design stage in our cost life cycle. So, how to get target cost again? Target cost is actually the difference between your market price minus your desired profit. So, for example, if you are selling a particular product and then you want to sell this at 500 pesos, so 500 pesos is your price, determined market price. And then how much profit would you want to earn from this product since you are going to sell it at 500? So let's say you want to earn a profit of 300 pesos. So therefore, your target cost is 200. What does this mean? It means that in producing this particular product, you must only incur 200 pesos in order for you to get your desired profit of 300 pesos. Okay? So target costing is a very useful way to manage the needed trade-off between increased functionality and higher cost. So, with its positioning in the early upstream phase of the cost life cycle, particularly on the design stage or design phase, target costing can clearly help a firm reduce its total costs. So, how to reduce costs to reach our target cost level? First, we can integrate new manufacturing technology using advanced cost management techniques such as activity based costing and seeking higher productivity through improved organization and labor relations. So, you need to make sure that your employees are also motivated. Second is design, um, or we are to redesign the product or service. This approach is more common than the first one because it recognizes the design decisions account for much of the product life cycle costs. Many firms actually employ both methods, which are operational control to achieve productivity gains and target costing to determine low cost design. So, how do we implement a target cost approach? So these are the steps in implementing a target cost approach. First is to determine the market price. You need to decide how much are you going to sell this particular product. Then second is to determine the desired profit. How much do you want to earn from this product? Next is to calculate the target cost at market price less the desired profit. So as what I have made an example a while ago, so your market price is 500, your desired profit is 300 pesos. So therefore your target cost is 200 and that is step 3. Then step 4, we have to use value engineering to identify ways to reduce, sorry for the wrongly spelled word, to reduce the product cost and then use Kaizen costing and operational control to further reduce costs. So in my example, since your target cost is only 200 pesos, your next problem to solve is how can we produce this product by only incurring 200 pesos? How? How can we reduce for example, currently we produce this at 250 pesos. So how can we lower it down to 200? So you can use value engineering. And then after using value engineering, we can use Kaizen costing and operational control to further reduce our costs. So what is the role then of value engineering? Value engineering is used in target costing to reduce product cost by analyzing the trade-offs between two things. First, different types and levels of product functionality, and second, total product cost. An important first step in value engineering is a consumer analysis that we perform during the design stage of the new or the revised product. The consumer analysis will then identify critical consumer preferences that define the desired functionality for the new product. The type of value engineering used depends on the functionality of the product. So, for one group of products, including camera, video equipment, functionality can be added or deleted relatively easily. These are products that have frequent new models or updates, and customer preferences change frequently. We can also say the same with cell phones or laptops. On the other hand, for another group of products, such as construction equipment and heavy trucks, the functionality of the product must be designed into the product rather than added on. So it must form uh, an initial part of the product itself. In contrast to the first group, customer preferences here are rather stable. Sorry, in contrast, rather in contrast to the first group, which are your gadgets. Now the second group, preferences of the customers for the second group are stable. Target costing is more useful for products in the what group? In the first group, because there are a large number of features about which the firm has some discretion whether to add it or not. Unlike for the second group, which are most of the features are really necessary. We don't have any discretion whether we can delete or remove that function or not. A common type of value engineering employed in these firms is functional analysis, in which the performance and cost of each major function or feature of the product is examined. So, the examples of types of value engineering are the following: functional analysis, benchmarking, design analysis, cost tables, and group technology. So, the most common type here is the functional analysis. And then when it comes to benchmarking, we already learned what is benchmarking. And then design analysis, this is also a common form of value engineering for products in group 2. When I say group 2, in my example, that those are your construction equipments and heavy trucks. So for example, more on industrial and specialized products. And then we also have cost tables. These are computer based databases that include comprehensive information about the firm's cost drivers. So we can use our management information systems. We can also use our enterprise research planning systems, our ERPs, such as SAP, Oracle, NetSuite, those products. Then we also can use group technology. This is a method of identifying similarities in the parts of products a firm manufactures, so the same parts can be used in two or more products, thereby reducing costs. And then after applying value engineering, what's the last step? To use Kaizen costing, right? So the fifth step in target costing is to use Kaizen costing. Kaizen costing occurs at the manufacturing stage. Unlike if you compare this to value engineering is done in the design stage. Kaizen costing, on the other hand, occurs at the manufacturing stage, so that the effects of value engineering and improved design are already in place at this point. So, the rule for cost reduction at this phase is to develop new manufacturing methods and to use new management techniques, such as your TQM, theory of constraints, which we will discuss later, and operational control as well. So, the word Kaizen is actually a Japanese word. It means continuous improvement. That is the ongoing search for new ways to reduce costs in the manufacturing process of a product with a given design and functionality. Okay, let's have an illustrative case for target costing. The company manufactures a wide variety of parts for recreational boating, including Part A and Part B component for high-powered outboard boat engines. The component is purchased by original equipment manufacturers such as Mercury and Honda, for use in large, more powerful outboards. The units sell for 510 pesos. So the selling price is 510. Take note of that. And the sales volume averages 25,000 units per year. 25,000 units per year. Recently, the company's major competitor reduced the price of its equivalent part to 450. So again, we are selling it at 510 pesos while our competitor is selling it at 450 pesos. The market is very competitive and the company realizes that it must meet the new price or else it will lose significant market share. The controller of the company has assembled these costs and usage data for the most recent year for the company's production of 25,000 units. So we have here standard costs and actual quantity and actual costs for materials, direct labor, indirect labor, inspection in terms of hours. So inspection 2,000 hours. Total cost for that is 350,000. Then materials handling, number of purchases is 56,000 number of purchases. Then the cost is 245,000. Machine setups, there are 3,500 setups with a total cost of 980,000. Then returns and rework, number of times 500 times. Returns and rework with a total cost of 65,000. The total actual cost is 11,169,000. So first requirement is to calculate the target cost for maintaining the current market share and profitability. So the total cost of producing our product, 25,000 units of our product is 11,169,000, right? Then how many products did we produce? 25,000. 25,000 units rather. So the total cost divided by the total units will give you the current unit cost, which is 446.76. So 11,169,000 divided by 25,000 units will give you 446 pesos and 76 centavos. Now, let's look at our current profit. Again, currently we sell them at 510 pesos per unit, right? Then the current unit cost as we just computed is 446.76. So our current profit per item is only 63 pesos and 24 centavos. If we want to maintain this level of profit, which is 63.24, and we want to match the selling price of our competitor, which is 450, instead of selling it at 510 pesos, we want to reduce it to match our competitor's price, 450 pesos. But we want to maintain or retain our level of profit, which is 63.24. So how much should be the target cost for each unit? So determined price, 450 minus our desired profit, which is 63.24. Therefore, our target cost is 386 pesos and 76 centavos. What does this mean? This means that from the current um unit cost of 446.76, we need to reduce our cost to what amount? 386.76 pesos. So the question is, next question is, can the target cost be achieved? And if yes, if it can be achieved, how? How can we achieve this target cost? Okay. So the target cost can probably be achieved by efforts in two areas. So if we compare the standard cost and the actual cost with respect to materials, there is an unfavorable materials variance because the standard cost is only 5,125,000, but the actual cost that we have incurred for materials is greater than the standard cost. Therefore, there is an unfavorable materials variance. So how much will that be? The materials variance, 375,000, right? The difference between the two. So 375,000 divided by how many units? 25,000 units. So that is actually 15 pesos per unit. So if we exert efforts to reduce or eliminate this variance, it will make our company more competitive. So that means that from our current unit cost of 446.76, if we can in fact eliminate our materials variance of 15 pesos per unit, that gives us 431.76. So a little bit, we lack a little bit more in order to achieve the 386.76. So what shall we do next? The manufacturing cost, except for the direct materials and direct labor, can be considered non-value adding costs. So what are the non-value adding costs here? When we say non-value adding costs, these are costs that do not add value to the functionality or quality of the product. So what are those? We have inspection, materials handling, machine setups, returns and rework. We can actually reduce those. For returns and rework, we can exert efforts to make this zero because returns and rework are non-value adding. For machine setups, we can reduce this also. Materials handling, inspection. So if we exert efforts in producing high quality products, we can reduce inspection costs actually. So we can achieve the target cost by looking at those areas. Okay. Then the last topic will be theory of constraints. Okay. So here we have to identify and remove constraints in the system. TOC, or theory of constraints, is a process of identifying and managing constraint in making of products or in the improving of services. It also describes methods to maximize operating income when faced with some bottleneck and some non-bottleneck operations. So, in short, TOC is a technique used to improve the speed in the manufacturing process and thus the overall speed. If you are to improve speed in the manufacturing process, we can, as a result, we improve speed in the overall delivery of the product to our customers. So, in contrast to target costing, which focuses on the early phases of the cost life cycle, particularly on the design, right? The theory of constraints focuses on the manufacturing activity. This theory focuses the manager's attention on the constraints, or we also call it barriers or bottlenecks, that slow the production process. Theory of constraints emphasis on the improvement of throughput by removing or reducing the bottlenecks in the production process that slow the rate of output. So if we are to apply this in our real lives, theory of constraints, we have to um, decrease the friction, right? So, for example, your goal is to study at least 8 hours a day, then you look at the barriers or the constraints that hinders you from uh from achieving this goal, of studying 8 hours per day. So, for example, you could say that your Facebook application is a constraint, so you can delete it. Or, for example, if your study table, is very messy, so it creates friction on your movement leading to your accomplishment of the goal of reaching 8 hours per day of study. Okay, so you can apply theory of constraints. The theory of constraints defines three measurements. First is the throughput contribution, investments. Investments here is actually the sum of materials costs in direct materials, work in process, and finished goods inventory. It also includes research and development costs and costs of equipment and buildings. Then it also measures operating costs, all costs of operations other than direct materials incurred to earn throughput contribution. So operating costs include salaries and wages, rent, utilities, and depreciation. So what are the steps in TOC analysis? First step is to identify the binding constraints. To look for the constraint. Second is to determine the most efficient utilization for each binding constraint. So in this step, the management accountant determines how to most effectively utilize the firm's resources. Step three is to manage the flows through the binding constraints. So in step three, the objective is to manage the flow of production in and out of the binding constraint to smooth the flow of production throughout the plant. Step four is to add capacity to the constraint. As a longer term measure to relieve the constraint and improve cycle time, management should consider adding capacity to the constraints by adding new or improved machines and or additional labor. So for example, one of our constraints is that our current machines can only produce a specified number of products or units per day. So let's say this one machine can only produce 10,000 units per day. So that is a constraint. What if we want to produce more, but our machines, our current machines, are not capable of producing more? That is a constraint. So we add capacity, add new or improved machines. Or if our constraint is we lack the necessary workforce, so we can add new employees. Then the last step is to redesign the manufacturing process for flexibility and fast cycle time. The problems requiring the application of TOC may also be resolved using your linear programming technique. You have learned this in your AC 1103. So you can revisit linear programming techniques. Okay, I have here an example. Cable Incorporated manufactures a part. We will call it part XX3. This part is used in automobiles. Three processes are involved in the production of this part, and these are drilling process, inserting, and packaging. Each process performed at a separate workstation and has these performance characteristics. The drilling function can drill only 30,000 parts per hour. Inserting function can insert only 3,000 parts per 5 minutes. The packaging function can pack only 10,000 parts per half hour. So you notice here that for drilling, inserting, and packaging, the number of outputs are expressed in different periods. So for drilling, that is per hour. For inserting, that is per minute. Oh, sorry. Can you change that, please? Take note. That's 3,000 parts per 5 minutes. Okay, per 5 minutes. Sorry for the lacking info here. So that's 3,000 parts per 5 minutes. Per 5 minutes. Okay. Then packaging is 10,000 parts per half hour. So let's all convert it into an hourly basis. So how many parts can we insert per hour? How many parts can you pack per hour? So the requirement here is for us to determine how many units of part XX3 can be manufactured in a week and which process is the binding constraint. Okay. So again, Step one is to identify the binding constraint, right? So here, the packaging function is the constraint. Why? Because it can only pack 20,000 parts per hour. If you convert this 10,000 parts per half hour, so in an hour, you can only pack 20,000 parts. How about for the drilling? You have 30,000 per hour. You can drill 30,000 units per hour. How about for inserting? You can insert 3,000 parts per 5 minutes. So that is equivalent to 36,000 parts per hour. So the constraint here is the packaging function because that limits your output for the week. So how many units of XX3 can be manufactured in a week? So let's assume a 40-hour work week. We work 40 hours per week. So let's pick the number of parts on related to the binding constraint. Again, the binding constraint here is the packaging. So it can only um, it can only pack 20,000 parts per hour. So let's assume that in a week, we have 40 hours of work. So that's 20,000 parts times 40 hours per week. So we can only manufacture 800,000 parts per week because of the constraint here in packaging. Can we increase our production? Yes, if we can improve our packaging function, right? Okay, so I hope you understood our discussion on these contemporary strategic cost management techniques. If you have any questions, feel free to message me in Canvas. Thank you so much for listening and have a good day. Stay safe always. Bye.